In this video, you'll learn the 10 ways to use infinite family banking, understand the infinite banking concept, and how you can become your own bank and see what a difference it can make in your life. Number one, debt elimination. If I could show you how you could be 100% debt free, including your mortgage and any student loans, and it wasn't going to cost you any more money what you're spending today, wouldn't you want to know more? Click the link in the description below. I go step by step through the process of exactly how this program works. And this is something that's been around for decades. It's been used by wealthy families like the Rothschilds, Rockefellers, and you may not know the concept, but once you see how it works, you'll see why so many people have been utilizing it. Now, like most people, they're interested to see how it works in a specific example, but better yet, wouldn't you like to see a written program for you on how you could be debt-free? Once you click that link in the description below and you watch how the process works, you'll be invited for me personally to go through a program to show you exactly how it can work for you and how it can make a difference in either your business or your family. Number two, as an emergency savings vehicle. Now, we all know, or at least we've been told, that we should have a set amount of money set off to the side that's only for emergencies. You know, grandma and grandpa's rainy day fund, they might have called it. But the question is, how much is enough for you? Some people might say a rule of thumb might be anywhere from 3 months to 9 months. Now, to some people, that might be no big deal. To some people, that might be stretching to think to put 6 months worth of income, let it sit in a checking or savings account that's earning less than 1%, to have that much money sitting there making no interest, actually losing money compared to inflation, just drives some people crazy. Maybe that's because it took them so hard and so long to set that much money off to the side. Well, let me ask you this question. If something happened to your health, if something happened to your career or your industry, and you couldn't work tomorrow, and you couldn't work for the next, say, 3 or 4 weeks, 3 or 4 months, how would that affect your personal finances? I know most people in America are $500 away from bankruptcy. Many businesses operate on a shoestring budget where they're reliant on that cash flow that come in just at the right time before they start taking on additional debt to cover that gap. So the question comes in some people, Mike, how in the world can I come up with 3 months or 6 months or a ridiculous 9 months worth of income if right now I'm just barely able to help my bills? Well, again, refer to step one of getting out of debt. Step two, one of the things that people like about this isn't like money that's sitting under your mattress or sitting in a silly checking or savings account that's making you virtually no money. Let's face it, if inflation, depending on who you ask, is 2+%, almost pushing 3%, then is making 0.5% to 1% in a checking or savings or even a money market account really benefiting you as far as having capital. This is something that gives people the value of compounded interest that grows tax-free, but always gives you the peace of mind that you have liquid funds. Liquidity equals freedom. Most people, when an emergency comes up, they just whip out their credit card. Many businesses go into the same situation. They didn't expect that key employee to leave. Their lease went up. Their industry changed. If you're in the automotive industry, or if you're in the seasonal, if your business is seasonal, or it's linked to things like the healthcare industry. And the healthcare industry, we obviously know, has made huge changes. If you have anything that you receive income, like a dentist, for example, on insurance, or a contractor, it's reliant on insurance funds to take care of some of the jobs you make. Something can happen that could really shake things up. So this gives people that I've personally been able to help that had anywhere from maybe 2 weeks to maybe no money at all in savings, to be able to have $80,000 to $100,000 liquid funds that they can use if they need it, that's inside their program in less than 3 or 4 years. And those are people that are actually in debt currently from credit cards, car loans, and of course, mortgage and overloan by student debt. So, how do you feel about losing over $83,000 of tax-free money? Well, I know that would take a big hit if anybody lost at the casino, but if you're utilizing a emergency fund and you're keeping it under your mattress in a safety deposit box, a checking or savings account that's earning next to no interest, then you're actually losing over $83,000. Now, let me show you how I came up with that. Let's say you and your spouse have a combined household income of $100,000 a year. Now, let's say that according to your professions, that it would take you longer than a couple days or a couple weeks to find another career if you lost your job or if something happened in your industry and you needed to make a change. Now, if you're working at the local drive-thru for minimum wage at McDonald's and you get in an argument with your boss, you could probably go right down the street to Burger King or someplace else and find another job and get a paycheck in about 2 weeks. So you know that you're probably going to have to be interviewing for a longer period of time. Or if you work in a career that's hazardous, maybe you are in something where you have a risk of being injured, that you want to make sure that you have more than just that minimum amount of income that you'd receive from your employer while getting healed up, ready to go back to work. So let's say, for example, you decided that 6 months worth of income is something that your minimum that you decided to have for emergencies. And those funds are just sitting in a checking or savings account that's earning next to no interest, then you still have to pay taxes on those funds every year. You know those annoying 1099s that you get in the mail around tax time? So it really doesn't have an opportunity to grow because you're having to shell money out to pay taxes on that small amount that you do make. If you only used the infinite banking system for one thing, and this one tip only, as a system to hold your emergency funds, you'd have over $133,000 if you had that $50,000 just in savings for emergencies over a 25-year period of time while your children were in their home. Now, though some of you may laugh and chuckle there, and I've had people smile and say, Mike, for the 20 years plus that my children were in the home, I couldn't afford or we weren't disciplined enough to save up a large savings account for emergencies. So if you actually have an emergency fund set up in place, the interest you would earn compounded, not including anything that you would get in addition in dividends, would pay out that $83,000. So if you started that when the children were little and had that until they were off into college, that would be $133,000 tax-free that you could utilize if you wanted to take care of children's student loan debts if you chose, or you could let it sit there or for retirement. Let's say it took you 25 years until you were 65 because you couldn't really afford to save or didn't have the discipline to save the funds up while the children were home. That's another $133,000 for retirement. So what would another $83,000 or $133,000 tax-free mean to you and your family? Number 3, purchasing a car. Now, this same concept and philosophy applies whether you're talking about buying a car, buying real estate for investment or to live in, or making any purchases for your business. Same concept and philosophy applies. Now, let's say we have 2 individuals, and one person goes in to make a purchase and for a vehicle, and they've got their checkbook in hand, and they've got $20,000 fully intended. That's going to be what they're going to use to purchase that vehicle. And we have person number 2 who walks in and intends to finance that. Now, whether it's through their own bank or credit union, or it's through somebody through the car dealership, we all know that when you finance something, you pay interest. Well, what is interest? It's money. The more interest you pay, the more money you pay. So where do you see yourself spending more money? Let's look at the 3 options, shall we? We take $20,000 and finance it at 5.33% interest over 60 months. We're going to pay $2,828 in interest, and after the 5 years, we're We're going to have a vehicle that's free and clear, that's 5 years older, and let's face it, if it's $20,000, it's probably not a brand new vehicle anyway. So if we paid $20,000 cash, we're going to walk off the car lot with a title and a car that's free and clear with no payments. So we're going to have a lot of benefits of that peace of mind of our cash flow because we have no payments, and we have a perceived savings of $2,820 in interest versus financing it. But we lost out on the value that $20,000 could make us or profit us over that same 60-month period of time. Meaning you traded the money in exchange for the vehicle. Well, most people say that's kind of obvious and what we take for granted, what it means when we make a purchase. So let's say we looked at the option of purchasing it through your own banking system. Instead of taking that $20,000 out of your own banking policy and removing it and sending it away from us to the bank at the car dealership, you're basically just taking a loan using the insurance company's money. Build up that $20,000 into your own banking whole life insurance policy, and you go to make a purchase for the vehicle. You walk off the lot with that vehicle in title in hand, free and clear, but you're taking a loan using the insurance company's money for the $20,000. The money that's yours stays in the policy and it still continues to grow, guaranteed compound rates of interest year after year after year. What you pay is a measly 1% back to the insurance company. Now, here's the beauty of it. You get the best of both worlds. The one thing people who write checks and pay cash for vehicles is they're not paying interest to somebody else's bank. Well, when you are the bank, you pay yourself back the interest. So once you pay that $20,000 off that you loaned from yourself from your own banking policy at that tiny 1% interest, once that loan's paid off, you still have the vehicle, you still have your $20,000, and you still earn the interest back. So which would you rather do if you were to finance? To pay $2,828 to somebody else, or to earn $4,333 all for purchasing a $20,000 vehicle? How many people think that every 5 years they could probably use a new vehicle, whether they need it or not? Would you rather spend money or make money over that 5-year period of time? Again, the same concept can be used for any purchases. Click the link in the video below for more detailed information and to have a free consultation that will show you exactly how this could work for you in your specific situation. Number 4, saving for college or educational expenses. You decide how much money you need or want to save. 2, you have guaranteed rates of return that's all tax-free. It's not based on the stock market where your funds can go up, they can go down. You're always going to know exactly how much money you have, so it's consistent. It also gives you the advantage that once those funds are there, it does not show if your child's trying to get additional funding. What are your children's needs? What if your child decides to go to the armed forces? What if they decide to open up a business? What if they go to become a skilled tradesman and work in electrical, plumbing, or welding, or something that doesn't qualify for any of those programs? You're in control because you are the bank. When do you pay the loans back? Whenever you want, or maybe never. Maybe by the time the children are out of school, you don't have a plan for them to pay it back, or at least a demand for them to pay it off. With student loans, if your children take out $100,000 or $200,000, which isn't uncommon. I've just recently talked to somebody who both of their children both have over $100,000 in student loan debt. So when they rack up that debt, no matter what happens, they cannot file bankruptcy or get away from that debt. Some people that we've been able to work with actually had debt schedules that would be over 100-year payment programs. If you want to see how long it's going to take you to pay off your student loan debt or what that would look like, again, in the link below, there's a link for our webinar. Go through those steps and we'll put a game plan together and we'll be able to show you exactly what the difference it's going to make with your current student loan. Is that, let's say they don't use it, that's money that can still be continually earning compound interest, and you never pay interest on the growth of that money. That's tax-free funds that will either be used for your retirement if you choose it to be, or maybe passed on to the next generation. If you've received some valuable information so far, go ahead and click like, subscribe, and don't forget to hit that bell, so that way you'll be reminded and alerted every time I upload a new video. Number 5, home improvements. Have you ever heard that expression, people don't plan to fail, they just fail to plan? Well, that's never been more true than we talk about home improvements. Where do you plan on getting the money to pay for that new roof? Well, most people, that my personal experience of having years of the industry, sitting at people's kitchen tables discussing where their finances are, I've ran into most people, their decision was to either just take that money out of a home equity loan or have a separate loan aside. When seeing people having some of these loans that are revolving, which is basically a giant credit card for $10,000, $20,000 or more, it's just ridiculous what they're getting charged. And again, it goes back to, are you paying interest to somebody else or are you earning interest because you're paying yourself back to your own bank? So let's see something that I've seen repeatedly over and over again. Someone's in their home. Let's say they pay off their mortgage even. They're retired in their 60s, 70s, or 80s. And they get this big home improvement and they say, you know what? We've lived in this house for 25 years. We can afford to go ahead and get new kitchens and bathrooms, and it kind of needs it anyway. The water's not falling on the floor, but they kind of deserve it. And their income's fine. They can easily take care of the payments. But what happens when John or Mary passes away? If you've got a $20,000 or $30,000 lien on your property because you used the home equity loan, your spouse is going to be forced to take care of that. That's not the case if you're using a loan through your own policy. What I mean is, if you die and you've got a $20,000 or $30,000 loan against your banking policy and you die, that debt does not go on to your spouse. Well, that's not the case when you talk about a home equity loan. Remember, when you take a home equity loan, even though you own the property outright, that lien is against the property. Now, if your spouse can't afford those payments or they can't sell the house, they can actually repossess their home because of that lien. So what that does is, many cases, is they don't budget based on if John or Mary passed away and left that other spouse in the home that extra monthly payment. So the concern that a lot of people have is, if you own your home free and clear and you need to get the equity out of it, how do you do it? Because you can't eat your drywall. If financial times get tough or your situation changes, or let's say you've got it wrapped up and you use that home equity loan to make improvements to hurry up and sell your property because you saw the market's changing, or maybe due to your work, you have to relocate to another state. How are you going to sell that house if you still have a lien against it? Some people, that's when we had the housing crisis, or a lot of people lost their home. They used up their home equity line of credit, or they refinanced their house for more than what it was worth to be sold in the marketplace, and they were forced to go into bankruptcy and their house was foreclosed on because they couldn't sell it quickly. So for people that are utilizing the banking policies in their life, when they die, or if they die, while the loan is still outstanding, they haven't paid it back, the death benefit of the policy will wipe that debt clean. So if the example is, I pass away and I've got a $20,000 loan on my policy and I die, that debt is going to be wiped clean, and there's still going to be a death benefit that's still going to go to my wife to make sure that she's taken care of. Now, again, most people don't get a banking policy and utilize it for the death benefit. But that's a concern for a lot of people, especially when you talk about home improvements. If they had the cash to pay for home improvements, they probably wouldn't be financing it. And again, do you want to have $20,000 as a safety backup, or do you want it wrapped up in your home? Tax-free retirement income. Let me ask you the question. Do you think that taxes are going to stay the same, go up, or go down between today and the day that you retire? If you said that they're probably going to go up, then why in the world would you want to continue to put money into a deferred tax retirement account? A 401k, for example, you don't pay taxes today, which I understand we all want to have tax deductions, right? But if you're not paying taxes on that today, at today's rate, and you're working full time, why in the world would you want to have it when you're on a fixed income or get ready to be on a fixed income when you retire and you think that taxes are going to go up? Well, where do you see yourself spending more money in taxes if you think the rates are going to go up? Today, when it's more affordable because you're working full time, or in the future when, let's face it, hopefully by the time you retire, you're going to have your house paid off. And if that's true, then you probably don't have that tax deduction anymore. So would you really want to be paying more money at that point? So one big benefit of having a tax-free retirement account, other than the obvious not paying taxes, is that all that money grows tax-free. All these things give tax-free passing on to any beneficiary that you choose because it's a life insurance product. It's not an investment. Now, what if you need to use your money before you're 59 and a half, but you've been told keep shoving as much money as you can into your 401k? Well, you better call your CPA or tax accountant to find out what taxes you're going to be paying and also how much you're going to be paying in penalties. Number 7, to start a business, expand your practice, or run for political office. If you're starting a business, you have to go to the bank with your what your assets are. They're going to know where you're going to come up with the resources when if your business fails. Here, you have none of that process. Also, there's an added advantage that if anytime in the future you do need to take some type of loan, the money that you took as a loan from your own policy doesn't show on your credit report. So again, there's the added advantage that you decide the terms, meaning, first of all, you're only getting to get charged 1% difference on the money that you're earning in your compound interest in your banking policy and what it cost you. And that's simple interest, not compound interest. So if you pay yourself back before the end of 12 months, you're paying less than 1%. Additional benefit, rather, for business owners is that you're not sure exactly when you're going to have the funds to pay it back, or if you're going to have ongoing business costs that you're going to have to invest in your business. This gives you the freedom and flexibility to pay yourself back and your policy when you need it. At any time and at any age, you can use your funds to run for political office. Former Senator John McCain used his whole life insurance policy and used loans, just as we were discussing here, to run for the presidential candidacy. Number 8, paying taxes and insurance. Now, this first example, we're going to use the escrow, the money that a lot of people like the peace of mind and comfort of sending it every single month to their mortgage company. That way they know that the average or what it's going to be for their taxes and the insurance for their property is going to be there, and they're not hit with a big bill every 6 months or for your insurance quarterly or annually. Now, if you took that same amount of money and you built it up inside your own policy, you're going to earn interest on that money. How much money do you think they pay you by holding your money for a year or every 6 months if you're referring to your taxes? Answer, 0. So what if you did this and replaced those functions in your life through anything else that you could pay annually? All insurance, whether you're talking about homeowners insurance, car insurance, they're going to give you a discount if you pay annually rather than monthly. So why not take advantage of that? You gain the advantage of earning interest where other people aren't giving you the advantage. And if there's anything else that you can add to that, negotiate, whether it's trash delivery, your internet connection for your phone bill and anything else. Or if you have a business, there's anything else that you can negotiate by paying large amounts, funnel it through your banking policy. You're going to earn interest and be ahead in the long run. Number 9, business growth or expansion. Now, this could also be classified if you're talking about an individual in personal growth in you. What investments do you need to be making into yourself? This could be getting fit, paying for a gym membership, self-development by investing in your relationships. If you're married, take that as a special time to invest in your relationship by going to a retreat, investing in study groups, investing in books to enhance your relationship. Either way, you're taking the funds that are financial and turning them into what it can benefit you in a larger scale. Now, when we talk about your business, that could be anything. That could be taking the funds out of your policy and loaning it towards investing in your employees, giving them a raise, giving them an incentive programs. Anything that you invest in your business, whether it's equipment and inventory, you can still benefit by using your banking functions in your life. And number 10, to make investments. Now, what I want to make sure that I clear before I go any further is that having your own banking system, utilizing the concepts of infinite family banking and the infinite banking concept, isn't an investment. Now, I know that's something that's surprising to some people because generally many people use the terms savings and investing synonymously. In other words, you'll hear a lot of people saying, I wish I could save more in my 401k retirement account. Well, when you put money into stocks, bonds, and mutual funds, those are truly, by definition, an investment. Meaning an investment, by definition, can go up or an investment can go down. There's no guarantee. Warren Buffett's first rule on money is to never lose money. And rule number 2 is don't forget rule number 1. So remember, you have to make sure that you save money in something that's guaranteed never to lose money first before you start taking risks, which is what investing is. So you have to make sure that you have your emergency fund in place and have something that's going to guarantee to give you a return on your investment before you can afford to start gambling with investments, because that's exactly what investing is. It's gambling. That's why Warren Buffett recommends that you think of investing like baseball. You don't have to swing at every pitch that comes along your way. Search to find only investments, things that you feel okay with taking an educated risk. Until you see that perfect pitch come right across the plate for a grand slam home run, you don't have to continually make investments. Buy low and sell high. Until you see the perfect opportunity and you're okay with the risks, let your money sit and have a guaranteed rate of return. That way you're not going up and down. The problem some people make is when there's a great opportunity for investment, for any type of financial opportunity, their money's all tied up into something else and they can't make the change. Whenever the market's going too good, that's usually when people want to get out. When you put money in your guaranteed rate of return through a mutual insurance company that's been giving dividend payments for over and above the guaranteed rates for over 100 years, you know that you're not going to be like the stock market. They've been paying that out through over 4 depressions and recessions. They've been it through the Great Depression. They've been it through the real estate. They've been able to see ups and downs, and even in the downsides, they've been able to make money. And the insurance carriers that we use that are all over 100 years old have never not paid a dividend payment in over 100 years. Now, the figures that I personally will put together for you will be over and above, or you'll be receiving dividends over and above the guaranteed rates of return that I will be able to show you. So again, if you'd like to see how all of these benefits, the 10 that we went over here, could benefit you personally, or do you like a personal consultation on how any of the benefits of infinite family banking could help you, your business, or your family, please contact me through the link below. And in the description at the bottom, there'll be a link to watch a 45-minute webinar where I go into more detail on all the information we covered here, as well as concrete examples showing you the math, and more importantly, to schedule a free consultation where I personally will go over your needs, find out what you want, and how we'll be able to make a difference. In the comments below, let me know which one of the 10 points surprised you the most, or which one you were most intrigued by, or maybe something that you have more questions on. And of course, like, subscribe, and don't forget to hit the bell so that way you'll be alerted right away whenever I have new videos posted every week. God bless and have a great day.